Ed, thank you so much for joining us here at Risk Minds International.
My pleasure.
It's fantastic to hear your insights, and you've been talking a lot about this extraordinary cycle that we're in, what the factors are that have led to it, and really what we've got to be aware of on the horizon.
Yes, well, we've been in this benign credit cycle now for over 10 years, and everyone knows it's got to come to an end. But the important thing is to be able to know when that happens and to transition into the next phase, which is probably a stress cycle. So I've identified 4 factors, which I discussed at the Risk Minds conference, that we must look at carefully over time. Default rates, particularly on the high yield bond market, recovery rates if there are defaults, the yields and spreads that investors are requiring, and then finally, how liquid is the market. If all of those are low default rates, high recovery rates, low required rates of return, and a lot of liquidity, clearly you're in a benign cycle, which is more or less what we are today, but we are seeing some changes. And I'd like to point them out if I may. First of all, default rates are going up, but they're still below historic average. So we're benign okay there. Recovery rates now, meaning what investors can receive back if there are defaults, or what distressed investors have to pay, are now falling. They no longer are high and therefore benign. They're about at the historic average now, around 45 cents on the dollar for recovery, which is an indication that we are perhaps going to the end of the cycle. Third, still investors in this low interest rate environment are more than happy to accept even a below average return because the alternative is so low interest rates from central banks, etc. So that's benign. And then finally, and here's where we do see some major changes, how easy is it for very distressed, or let's just say low quality companies to raise money, the so-called triple Cs. And here we are seeing that for the first time, particularly in the last 2 quarters, they are having a much more difficult time. They are issuing much fewer bonds. Investors are less interested, or investors require much higher returns than in the past. And so this, along with higher default rates and lower recoveries, are beginning to show some stress in the system. We're not there yet, and probably won't be for another 6 to 12 months.
So maybe a couple of little red flags on the horizon. Do
Yes.
you think there are other external non-financial factors that are going to have an impact as well? Because we're looking at a very sort of turbulent geopolitical time ahead with UK election, US election, Brexit. There's lots on the horizon, isn't there?
Yeah, well, those non-financial or non-economic factors are always there. If you combine them with economic downturn, which is showing in China, beginning to show in the US, although it's still relatively good, then you have the catalyst potentially coming from the non-financial and the fundamentals being weaker and weaker. And when that happens, you're going to have a stress cycle, clearly, and it's long overdue, in fact. We've been artificially being, say, in this benign cycle now for several years in terms of the low interest rates and liquidity pumped in by the central banks. It's very hard to quantify the non-financial factors and their likelihood, so I like to stay away from that. I like to concentrate on the things we can measure.
Talking about that, we're obviously celebrating 50 years of ZScores. Tell me about that, how important that's been, and whether you think companies now are listening to that enough and are learning from history.
Thank you for bringing that up. Yes, it has been an incredible run of over 50 years. I've been in the business then a lot longer than most people in the credit risk business. I've seen it really mature to a great extent, but there are signals from that perhaps you're right, a lot of people are not looking at. For example, the average Z-score today of, say, more risky companies compared to 2007 is about the same or slightly better. But when you say slightly better to what it was in 2007 when it was risk on, it means that it's really the companies are still quite vulnerable. And it's not really good news, even though slightly better sounds better than slightly worse. And we ran the Z-scores on these large samples of companies, 600 of them in the US, and we do find that they're about the same or slightly better, which means that high vulnerability, especially when the macroeconomic conditions change. I was very happy and very pleased to be asked to speak about the evolution of Z-scores and what have we learned in another session, as you probably know, Emma. And one of the things I'm happy to discuss here, which I didn't get a chance there, is what is it telling us about the credit cycle? The other thing I'd like to emphasize about the 50 years is the fact that the average company today is far more risky than it was 50 years ago. And yet many people who read about the Z-score either on the internet or in textbooks or on some database are unaware that the original models, guidelines for distressed and non-distressed have changed. But they're using it as if it hasn't changed, and that's unfortunately a mistake. So I'd like to point out that cutoff scores for Z-scores pointing to distress now are quite a bit lower than they were 50 years ago because of the fact that the leverage in the financial system is so much higher than it was before. And that, by the way, is also one of my major concerns about when the next cycle turns, what will be the impact. With so much more debt in the system, there are going to be a lot more defaults. Not necessarily higher default rates because the denominator is going to be also high, but the dollar amount of defaults, certainly in the US and also increasingly in other countries like China, are going to be much higher because of the huge buildup in debt.
So it could be a much harder fall when it comes.
Yeah, it'll be definitely longer, deeper than it's been before, but possibly not as severe unless the real estate industry also suffers, maybe not as much as last time, but suffers a lot compared to what it's now going along, cruising quite well. But we are seeing cracks in that system in the US, and I think the bubble is definitely there in many countries, how expensive real estate is now, and there's only one way to go. I shouldn't say there's only one way, but people oftentimes think real estate prices will only go up. We know now it doesn't happen. It can't happen the other way.
So with all of that in mind, just to finish off, what would you hope is the key message that these guys would take away from hearing you speak at this conference this week?
Well, the risk-on situation, which is so prevalent today and have been for almost a decade now, needs to be geared back. And it's beginning to happen in the triple C segment. I think we underestimate the impact of even investment grade defaults, downgrades will have on the system. And finally, I'd like to say a few words about this zombie firm concept, which is so prevalent in Europe and needs to be really understood. If firms are kept alive artificially by low interest rates, refinancing, banks not wanting to write off the loans, that's really bad, not only because it's a misallocation of resources, but also because it is feeding disinflation or deflation by these firms trying to stay alive by lowering prices. In the US, we also have zombies, but that's becoming likely to change because the triple C segment, which is our, say, zombie section, will suffer a lot in the next recession and defaults. It's easier to default in the US than in Europe. And Europe needs to say, maybe we should making a mistake by keeping these firms alive artificially. And if that's the case, then maybe some pain is necessary in order for the longer term to grow.
So look at history and beware the zombies.
Beware the zombies. That's a good point.
Thank you so much for sharing your insights. It's been great to talk to you. Thank you.
Thank you. My pleasure.